Hello and welcome to The Trade. Before we get to the charts, let's take a look at what's going on at a macro level. President Trump saying the US is reinstating its blockade of Iranian shipping in the Gulf and will ensure the Strait of Hormuz stays open for a fee following more missile and drone attacks. Posting on social media, he said the US will be from this point forward known as the guardian of the Hormuz Strait. But as such, a matter of fairness, will be reimbursed at a rate of 20% on all cargo shipped. Well, US forces struck a submarine and ship and maintenance facility, while Iran claims to have targeted US military facilities in Bahrain and Kuwait and destroyed radar systems in Oman. Well, concern now returning about the inflationary effects of rapidly rising oil prices, with US Fed member Christopher Wallace saying if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. Those concerns reflected on the Treasury market, US yields jumping the US 2-year at 4.28%, the 10-year at 4.62%. Markets pricing in a 45% chance the Fed funds rate will be hiked by 25 basis points in the next meeting at the end of this month, 100% chance of a hike by September. The US dollar index was up 0.5%. The Aussie is currently trading at 69.2 US cents. Well, let's turn to the charts and to unpack them. We are joined by Chen from Vantage Markets. Heavy, great to catch up with you again. A number of events to consider this week, not the least, of course, what we're seeing with inflation. But we're actually going to take a look at earnings because US earnings season kicks off tomorrow. You're taking a look at Netflix. What are you seeing here?
Yeah, good morning, Andrew. Thank you for having me today. Well, yes, I think apart from the tomorrow's financial stocks, Netflix is definitely one of the stocks to watch this week. And especially Netflix has just suffered a quarter-long downtrend after previous earnings now losing about 32% in the past 3 months. So fundamentally, I'll just quick explain why the April starting the sell off for the stock is that the investor seems to quite not happy about their softer Q2 guidance, as I'm putting up the table here. So they're showing the Netflix expected the Q2 growth will down to 13.5%, and that's the lowest levels in 5 quarters. But I also showing that it's actually quite big mix numbers here. So if that's something that we are expecting for the upcoming earnings. They're also showing that operating income is actually improving. The margin remains quite resilient. So it just highly depends which news that investors want to take in with more credit, and that would definitely highly depends whether or not the Netflix could recover or even further down from these upcoming earnings. Technically, you can see that the price is still quite trapped inside a clear descending channel below all its moving averages and roughly about 30% down beneath its April peak, showing that the bear is still quite firmly in control. And the slightly positive side is the MACD is still deeply negative, but it's beginning to show some early signs of bottoming here. The first improvement for buyers, I think I would expect a break above the channels. I think that will be a quite important for the Netflix to recover with resistance near 78 level. A move above 83 that would suggest earnings have reset the chance, and that would recovery, a probably more convincing recovery could happen. But if that does not happen, a failure break higher that will keep the lower high structures still in the shape and bring the 68 support back in focus again.
Okay. That's a stock to watch out ahead of US earnings season. Heavy, let's bring it back home with a look at the largest stock on the local index in BHP. And fascinating to see what's going on in commodities at the moment, particularly given developments out of the Middle East. What are you watching for with BHP?
Well, I think this week is also quite important for BHP, as this is a company to face 2 steps of test this week. On Wednesday, we'll have China's GDP and bunch of economic data. They will testing and reshape our expectation for the commodity market. But on the Thursday, we're going to have the BHP's operational review report, and that will bring more of the executions and review assessment for the company. So I think these 2 steps will definitely provide quite comprehensive view for the company itself. Technically, you can see from the chart here, the BHP has pulled back sharply from its recent peak, roughly about 11% down from its recent peak above 68. But it's now, you can see that it's attempting to stabilize around the 56 to 58, but still beneath the 60 psychological level. I think the price also holding between the 50% and 38.2% Fibonacci retracement level, showing that this area is now providing the temporary support at the moment. For buyers, I think the first positive signal, if you are expecting there will be a rebound above 60 psychological level and the 60-20, where the 20 and 50 days moving average meets at the moment. Above the level will open the way and potentially putting the recent consolidations at the back. But if that rebound fails, I think that descending trend lines will continue to cap the stock and keep the corrective structure intact, and then a break below 56 will weaken the base at the moment and shift the focus towards even further down to around about 54 level. But again, this week I think it's quite of the catalyst and the fundamentals that will change and reshape the sentiment for BHP more.
All right, key levels to watch out for with BHP. Finally, Hebby, let's turn to gold now. Those inflationary concerns driven by higher oil prices back in focus, potentially forcing central banks to move rates higher, and that's no good for news. How's it been reflected on the chart? No good for gold, I should say.
Yep. So as people aware that gold seems to face another round of selling this week, I think as Chris just explained that the geopolitical tension has now translated more into the inflation and the stronger dollar expectation, and that's where that major pressure putting on the gold. I often been asked why that this year the safe haven seems to didn't help this gold to support, but rather than it's more about the pressure here. So I want to explain a little bit from my perspective, and I'm putting up two graphs here. They showing that the quite divided view from the retail traders as well as the institutional traders. On the left chart, the graph here showing that the ETF flow. So you can see a quite sharp decline in terms of ETF flow for the gold this year. On the right hand is the central bank buying, and you can see the central buying still actually rebound and still holding there even that into the May this year. So it shows that the divided picture is that retail traders seems to have left the table because of the weakness for the gold prices, but we still have a longer term that the central banks is putting a strong buffer and the support for that. But for the near term wise, I would say that the weakness still dominates. The gold remains quite trapped in the cleared sequence of lower highs, as I'm putting up the yellow highlights here. There's a couple of the lower highs is happening. I think that's one of the signs and negative signs for that, showing every time is more of the profit takers rather than the fresh buyers for the average rebound, and that showing quite of the bearish side for the gold, because every time that if the price rebound, we're only seeing that more traders are leaving the table. For the near term wise, I do expect the buyers that will join only after a break above the 4187 to 4258 resistance zone. But if that doesn't happen, even the next rebound will likely to make another lower high, and that will bring our attention back into the level below the 3900, the 3900K levels, and that will even expose 3451 if the level doesn't hold. So overall, I would say that the fading retail liquidities is left the near-term sentiment still pretty weak for the gold prices.
Hebby, terrific to get across the charts in your focus at the moment. Thanks for joining us from Vantage Markets. And that is the trade.